Pantheon AI presents OPEC surprises on oil chime buoyed and MicroStrategy pauses Bitcoin markets dip. Good morning, everyone. Welcome to the PAI Morning Briefing. I'm your host, and it's July 7th, 2025. Hope you're all feeling sharp and ready to dive into today's market landscape, because we definitely have plenty to unpack.
Absolutely, John. And as always, we're here to help you navigate all those twists and turns of the financial markets with, clarity, expert insights, and just a touch of humor to keep things lively. It's never a dull day, is it?
Never. Let's kick things off with a quick market overview. As I'm checking the pulse of the major indexes this morning, the S&P 500 is trading at roughly 6,234.92. It's seen a mild decline of about negative 0.385%.
So a bit of a dip right out of the gate then?
Exactly. Meanwhile, the Dow Jones stands at around 44,417.67, down by roughly negative 0.86%. And the Nasdaq isn't far behind, sitting near 20,461.74, slightly down by about negative 0.14%.
So pretty much everything's in the red today, huh? What about the smaller caps, like the Russell?
You got it. The Russell 2000 is trading at roughly 2,227.06, reflecting a dip of negative 0.467%. So, yeah, it's a cautious start across the board for traditional markets.
And how's the crypto world faring? I always feel like it dances to its own tune, but sometimes it mirrors the broader market.
It's a bit subdued today, actually, much like the traditional markets. Bitcoin is currently priced at approximately $108,451.44, with a decline of negative 0.71%. And Ethereum follows suit, trading around 2,541.17, down by nearly negative 1.16%.
So even crypto is feeling that cautious sentiment. It really reminds you that even small daily moves can keep us on our toes, doesn't it?
It really does. Now, let's take a deeper dive into some major market trends influencing these numbers. In many ways, we're witnessing a market that's balancing between cautious sentiment and opportunities that might just be around the corner.
That's a great way to put it, John. These slight declines across the board really suggest that investors are scanning for areas of structural weakness rather than reacting to any immediate specific catalyst. It's not a panic, it's more like a careful assessment.
Precisely. There's this prevailing sense that while some sectors might experience headwinds, the underlying fundamentals of many companies remain robust. It's almost like the market is playing a high-stakes game of keep calm and carry on, with traders weighing risk and reward in real time.
I like that analogy. Speaking of weighing risk and reward, one significant development that's certainly caught the attention of market watchers is in the energy sector. Oil prices have been on a bit of a roller coaster recently.
Oh, definitely. Despite the announcement from OPEC Plus about additional barrels, oil has really just shrugged off these changes, barely reacting to the sudden injection of an extra 548,000 barrels per day starting in August.
And to put that in perspective, experts were expecting an addition of only 411,000 barrels per day, following a more steady trend. This unexpected move by the group is such a classic example of how OPEC has a habit of tripping up even the most seasoned fundamental traders.
It really raises an interesting question, doesn't it? Are we underestimating the effect of geopolitical events on energy prices? Or is this just another routine recalibration in global oil markets?
That's the million-dollar question. Shifting gears a bit, there's been significant buzz around Chime Financial in the financial sector. JP Morgan's Tien-Tsin Huang recently initiated coverage on this bank services company, assigning it an overweight rating and projecting a potential 25% stock price gain over the next 12 months.
A 25% gain in a year? For those not immersed daily in the trading floor antics, that might seem like a lofty expectation. But the analyst's commentary has certainly generated a lot of excitement among investors.
Right? And you might think of Chime as just another fintech player, but the momentum behind its hot initial public offering has certainly turned some heads. The conversation now centers on whether these high-flying stocks are truly poised for growth, or if we might be witnessing a bubble waiting to burst.
I like to joke that chasing these hot IPOs can sometimes feel like trying to catch a greased pig at a country fair. Challenging, to say the least.
That's a perfect analogy, John. And in a similar vein, another story circulating involves banking stocks, where some portfolio managers have expressed caution. Several sources note that investor sentiment has shifted towards taking profits from top-performing bank stocks.
So there are whispers that some managers are reviewing every position within their portfolios, pondering whether they might be too greedy following the recent upswing. It's a balancing act, isn't it? The lure of rapid gains can sometimes overshadow the wisdom of a well-diversified strategy.
Exactly. Plus, in an extremely overbought market, the discipline of booking profits is often the soundest strategy. If you're wondering if this trend will persist, you have to ask yourself, is it better to enjoy the gains while they're hot or to wait for a potential market correction to get a better entry point?
It's a debate that truly has no one-size-fits-all answer. We also have to discuss some intriguing movements in the cryptosphere with MicroStrategy making headlines. For the first time in 3 months, MicroStrategy did not purchase additional Bitcoin.
Wow, that's quite a departure from their recent trend of accumulating crypto. It's left market participants speculating on the strategic pivot behind it. Could it be that the time is ripe for a change in strategy, or is this simply a temporary pause in an otherwise aggressive buying trend?
The company's decision certainly invites us to ponder the broader implications for institutional involvement in the crypto markets. After all, when a major player switches gears, it's a signal that might be worth considering as part of a larger trend.
Absolutely. Let's pivot now to some more detailed sector analysis, starting with technology. Despite the day's overall declines in the major indexes, technology companies continue to drive much of the innovation and underlying confidence in the market.
Right. With the Nasdaq representing such a diverse range of tech giants, even minor fluctuations can signal shifts in investor sentiment. Today's slight dip might feel disappointing, but seasoned investors know these movements are often temporary corrections in an otherwise bull-driven narrative.
And long-term growth in sectors like cloud computing, artificial intelligence, and cybersecurity continue to outpace short-term volatility. In fact, you could reasonably argue that the inherent resilience and adaptability of tech companies make them a cornerstone in a volatile market environment.
They really do. On the energy front, we've already touched upon oil prices and OPEC's announcement, but it's important to consider that the energy sector isn't just about crude oil. It's about the intricate dynamics among geopolitical tensions, supply chain intricacies, and shifting global demands.
Exactly. While the oil market shrugged off the extra barrels this time, the energy sector remains incredibly sensitive to changes both in production quotas and broader geopolitical events. Investors are keeping a close eye on how these factors will impact earnings in the coming quarters, making energy an area rife with both risk and opportunity.
I often say that if the oil market were a roller coaster, we'd be in for a ride that's as unpredictable as a cat deciding whether to take a nap or go on a midnight adventure.
That's so true. Turning to finance, the breadth of our discussion today around Chime Financial and the broader strategy around banking stock profit-taking really underscores a key theme. In times of market strength, even the most promising stocks deserve a discerning eye.
The finance sector has seen a variety of movements, from bullish analyses predicting substantial gains to cautious strategies urging profit booking. The risk-reward equation is constantly recalibrated based on new data, making it crucial for investors to keep an open dialogue about how best to position their portfolios.
It really is a bit like trying to decide whether to speed up at a green light or take a more measured approach, knowing that a sudden red light might be waiting around the corner.
Yeah, perfect analogy. From a global market standpoint, these trends have broader implications. The movement of major indexes not only reflects domestic economic uncertainties, but also mirrors the international interplay of trade, policy, and investor expectations.
And with energy, tech, and finance all showing signs of cautious optimism, we have to ask ourselves, what does this mean for co-movements in emerging markets and Europe? Global market participants are increasingly watching for signs that domestic policy or international events might tip the balance one way or another.
It's a conundrum faced by investors around the world. How do you stay nimble and well-positioned when events on one side of the globe can cause ripple effects here? These are the very questions that keep market analysts up at night and spark lively debates over morning coffee.
Definitely. Now let's summarize and dive a bit deeper into some of the 15 or so important stories that are making waves today. First, as we discussed, the oil market continues to be a point of contention. OPEC Plus has once again surprised the market by adding an extra 548,000 barrels per day starting in August, rather than the anticipated 411,000.
This adjustment, while seemingly minor for the overall market, holds significant implications for traders focused on the energy sector. The question for oil investors is whether this additional volume will lead to any sustained downward pressure on prices, or if it's merely a short-term adjustment before spot demand and production stabilize.
Secondly, Chime Financial remains under the spotlight as JP Morgan's Tianxin Huang kicks off coverage with a strong overweight rating and a predicted 25% surge in its stock price over the next 12 months. The interest in Chime isn't happening in a vacuum.
No, it's part of a broader narrative where fintech companies are disrupting traditional banking models, and their rapid growth trajectories create both excitement and considerable volatility. For investors, this insight begs the question, is Chime poised to redefine retail banking? Or is its current valuation perhaps inflated by the fervor surrounding its recent IPO?
Our third major story involves the banking sector once again. Here, we're hearing from several portfolio managers who are actively booking profits in top-performing bank stocks due to concerns that the market is becoming extremely overbought. The underlying strategy here is a classic, take gains while you can approach.
Right. With valuations soaring past what one might consider sustainable in the short term, the risk of a market correction has become too significant to ignore. It really has our listeners asking, when is the right time to take profits? And how do you balance the desire for continued gains against the need for risk management?
Another noteworthy headline pertains to MicroStrategy and its recent decision to hit pause on purchasing Bitcoin. For a company that has built much of its reputation on being a relentless buyer of digital gold, this pause is certainly a departure from the norm.
It throws up several questions regarding whether this signals a broader strategic shift, or if MicroStrategy is simply recalibrating its approach amid market volatility. With Bitcoin itself floating around $108,000 and change, the timing of this decision lends weight to speculation that institutional investors might be reevaluating their positions amid broader market uncertainties.
And we've also encountered several repeated headlines and summaries around these topics, almost as if the market itself is hammering home the importance of these narratives. Whether it's Chime Financial's bullish future, the cautious revenue-taking in banking stocks, or MicroStrategy's crypto pivot, it's clear that these themes are resonating across multiple platforms.
That repetition might be a signal that investors should perhaps pay extra attention to these developments. After all, when multiple sources highlight the same story, it tends to reinforce a sense of urgency, or at least a cautionary note in the minds of market participants.
Beyond these four marquee stories, there are additional narratives emerging in various corners of the financial world. For example, some analysts are beginning to scrutinize the consumer spending data coming out of Europe, noting that diminished retail sales in certain regions might signal a broader slowdown in growth.
And in Asian markets, there is cautious optimism that slowing inflation might lead to central banks easing policies, thereby stimulating economic activity. While these stories might not take center stage on our morning agenda, they form the backdrop of a global market that is interconnected and highly sensitive to shifts in consumer behavior, policy decisions, and international trade dynamics.
There's also been chatter about the bond markets gearing up for what could be another round of rate adjustments by central banks. With inflation figures easing yet economic growth remaining rock solid, investors are walking a tightrope between seeking yield and managing risk.
In this environment, even a slight hint from the Federal Reserve that policy might shift can have ripple effects across equities, fixed income, and even cryptocurrencies. It makes one wonder, are we on the cusp of a new era of monetary policy adjustments, or are these merely jitters in an otherwise stable global economy?
That's a big question. One more story that's worth our attention is related to tech earnings. A few leading tech companies are expected to announce their quarterly earnings in the coming weeks, and early sentiment suggests mixed results.
Some companies are beating expectations, while others are issuing cautious forecasts for the remainder of the quarter. This has led to a fascinating debate among analysts. Is the tech sector poised for continued growth, or will we see a period of consolidation as profit-taking begins to creep in? It's not unlike the age-old debate of whether it's wiser to plant a garden and nurture it slowly, or to invest aggressively and harvest quickly.
The truth, as always, may lie somewhere in between. So as we transition into our sector analysis, let me just touch on technology, energy, and finance in a bit more detail. Starting with technology, despite the day's modest downswings, there's an undercurrent of strength.
Absolutely. The Nasdaq, while experiencing a slight dip, is still home to some of the world's most innovative companies. This sector remains highly competitive and dynamic, with robust growth forecasts underpinning strong fundamentals. While the short-term volatility can be jarring, long-term investors understand that technology tends to weather such storms with impressive resilience.
Think of it as the creative genius of a startup that might stumble in the early days but eventually changes the world with its disruptive ideas. That's the narrative driving technology stocks today. And in the energy sector, oil's reaction to OPEC's move is certainly a story that resonates with both fundamental traders and technical analysts alike.
The decision by OPEC Plus to add extra barrels is a reminder that in global energy, there are many variables at play. Supply, demand, geopolitical stability, and even seasonal patterns all factor into oil prices. Despite the extra barrels on the market, the current resilience in oil pricing suggests that underlying demand remains robust.
The lesson here might be to never underestimate the power of market fundamentals, even in the face of sudden changes in production quotas. And if you find yourself scratching your head over a barrel or two of extra oil on the shelf, remember that in energy markets, a little unpredictability is just part of the everyday business routine.
Exactly. In our finance segment, the juxtaposition of bullish forecasts for Chime Financial and more cautious profit-taking in established banks paints a vivid picture of the current market mood. On one hand, Fintech companies are capturing the imagination of investors with growth projections that light up the board.
On the other, traditional banks are being eyed very critically, with some managers saying, "Enough is enough. It's time to lock in gains before the market shifts." This dichotomy is fascinating because it encapsulates the very essence of today's financial ecosystem, one that is equal parts innovation and caution.
It's almost as if the market is teasing us with the possibility of high rewards while simultaneously reminding us of the age-old wisdom of diversification and risk management.
From a global perspective, these sectoral shifts have far-reaching consequences. For investors all over the world, movements in the U.S. energy sector or the unfolding tech narrative in Silicon Valley send ripples through emerging markets and European economies.
It raises the question, how do you strategically position your portfolio when the world is more interconnected than ever, with geopolitical tensions simmering in some parts of the world and economic policies shifting rapidly in others? Understanding these international linkages is crucial.
As we scrutinize these trends, it's important to ask ourselves, are we truly prepared for the next global market shock, or are we just rearranging deck chairs on the Titanic?
Hopefully the former. Looking ahead, let's discuss some expert insights and predictions. Many analysts are betting on a rebalancing act in the coming months. For instance, while the current market dip in major indexes might look like cause for concern, it could potentially represent a healthy correction leading to stronger, more sustainable growth.
The energy sector, despite its current volatility, is expected to stabilize as global demand recovers gradually from any residual oversupply issues. In the tech arena, future earnings reports and continual innovation may well drive home the point that even a brief decline is not indicative of long-term weakness.
And for those in the financial sector, it appears that strategic profit booking could pave the way for a more measured and deliberate re-entry into the market at opportune moments.
One piece of advice from our conversations with industry experts is not to be swayed by short-term noise. Markets, as you know, function in cycles. The key is to maintain a balanced perspective, ensuring that your portfolio is diversified not just across sectors, but also across different asset classes.
This approach can provide a buffer against volatility, while still allowing you to capture growth opportunities as they emerge. It's a bit like riding a bicycle on a rocky path. You have to maintain your balance, steer carefully, and sometimes just hold on tight when the road gets bumpy.
That's so true. Now, since we've covered a robust list of stories, from oil production decisions and fintech optimism to cautious profit-taking in banking stocks and shifts in institutional crypto strategies, let's take a moment to reflect on the broader market implications.
These diverse narratives illustrate an environment where investors are navigating through a mix of traditional market fundamentals and innovative, sometimes disruptive, new players. We are witnessing all of these elements converge, creating a landscape that is as challenging as it is full of potential.
In this respect, the market isn't just about numbers on a screen. It's about understanding the story behind those numbers, the human element behind every trading decision.
I'm reminded of a humorous analogy that one of my colleagues shared recently. Investing is a bit like ordering your favorite coffee. Sometimes you get the perfect cup, sometimes it's a bit off, and sometimes you wonder if the barista was playing tricks with your order. The key is not to let one off day spoil your love for the brew.
Exactly. Similarly, market fluctuations shouldn't deter you from sticking to a well-thought-out investment strategy. Instead, use them as moments to reflect, adjust, and, if needed, laugh at the absurdity of it all.
Before we wrap up, let's leave you with a few thought-provoking questions. Are you positioned to take advantage of short-term corrections in your portfolio? How might emerging global economic policies shape your strategy in the coming months? And in a world where both traditional sectors and innovative disruptors continue to vie for our attention, which stories resonate most strongly with your investment philosophy?
These are not just rhetorical questions. They are essential reflections to help you refine your strategy and be agile in today's ever-evolving market. So in conclusion, here are the key takeaways from our discussion today. We've seen that the major indexes, from the S&P 500 to the Dow Jones and Nasdaq, are experiencing slight declines, reflecting a cautious sentiment among investors.
Cryptocurrency markets, represented by Bitcoin and Ethereum, show similar modest downward trends amidst ongoing volatility. The energy sector remains a central topic due to OPEC Plus's unexpected barrel increase, while the finance sector grapples with diverging narratives between Fintech optimism, as exemplified by Chime Financial's bullish forecast, and traditional banks where profit-taking is gaining traction.
Additionally, MicroStrategy's pause in Bitcoin acquisitions adds another interesting twist to an already dynamic investment landscape. We want to extend a special shout-out to Pantheon AI, your information co-pilot, as we continue to bring you these insights each morning.
We hope that you find these analyses both informative and thought-provoking. Remember, in this world of markets, learning shouldn't feel like a full-time job. Stay curious, stay engaged, and let each day's challenges inspire smarter, more strategic moves.
Thank you for joining us this morning. We look forward to having you back for our next episode tomorrow. And as always, if you have any questions or need further insights, you can always ask questions to our AI co-pilot. Until then, keep your focus sharp, your strategy sound, and remember, learning shouldn't feel like a full-time job. Have a great day, everyone. Pantheon AI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.